Well, good afternoon, everyone. I'm Austin Durfeld, Extension Educator and Ag Economist for the Southeast Region in the Department of Agricultural Economics at the University of Nebraska-Lincoln. Thanks for joining us today. This series of webinars is produced by our Extension Farm and Ranch Management team and usually runs every Thursday at noon. Find recordings and a schedule of upcoming webinars at farm.unl.edu. We would like to quickly highlight the Nebraska Rural Response Hotline. In times of stress, knowing when to reach out is essential. The Nebraska Rural Response Hotline can provide mental health counseling, information regarding legal assistance, financial clinics, mediation, and more. The hotline's toll-free number is 1-800-464-0258. A wealth of resources related to stress and wellness can also be found at ruralwellness.unl.edu. During today's presentation, please use the chat box or Q&A located at the bottom of your screen to ask questions. We will address those at the end. Presenting today is Tina Barrett, a farm financial consultant and director at Nebraska Farm Business Incorporated, which provides financial analysis, business planning, and tax services to over 400 farm and ranch businesses across the state. She will be reviewing recent updates to tax law that are important for farmers and ranchers to be aware of as they prepare to file, including the many new considerations under the CARES Act. Tina, thanks for being here with us. I'll turn it over to you.
Sounds good. All right. We'll get started here on such a fun topic on a Thursday afternoon, but it certainly has been a very busy year with all the changes, all the program payments that have been made out. So there's lots to cover, lots to talk about. So we'll get through that. For those of you that don't know me, I work, I'm the director at Nebraska Farm Business. We're an accounting firm. We do taxes, tax management, cash flow, business planning, those kinds of things, as well as the financial analysis. So if you've ever heard me talk about, the averages that we're seeing amongst our states, that's where those programs are coming from. So we just work with farmers all across Nebraska in a kind of full range of their financial management. And that's why I get to have the fun job of knowing these things. So, okay, so this is kind of where we're going to start off. We're going to talk a little bit about PPPs. We're going to go through some of those government payments and how they're going to be taxed. A couple changes on the net operating loss and retirement things that changed in the CARES Act, as well as just a quick note on Charitable and the employer credits. And then there's just a few random things that really weren't necessarily changes, but things that I think are important farmers think about this year that maybe are a little different. So let's start with that ever popular PPP program. My daughters we spend enough time at the dinner table talking about this that they're also like tired of hearing about it, and I'm kind of with them. But we're going to start with a poll, and so Austin's going to throw into the chat box the link up there, but you can go to any browser if you want to and put in that pollev.com website. We're going to make this interactive today because I want to find out where everybody's at and kind of get a feel for what we need to talk about some too. Or you can text. You can text to the number you text to is the 22333, and then you text that Tina Barrett 204, and then you can text your answer in. So either way you want to respond, feel free to do that. We'll give everybody a minute here to do this, and then we'll check out the results live. So don't answer in the chat box. Try and go to, there we go, to the website, and then you can respond. And yep, we can see those responses starting to come in now. So there, we've got that poll or that link right there in the chat box. So you can go to the chat box, click on the link, and then you can put your answer in here. Starting to get those PPP responses. This was something that, from starting the end of March, clear through July seemed to be a topic of conversation for just about everybody. So let me give you, while you're answering, for those who don't know about this program, this was part of the CARES Act. So that was the major, there were 3 stimulus packages passed fairly quickly there in March. This was the big one. And so what this did was allowed people, businesses, to apply for this loan through the Small Business Administration and get funding to really, the idea was to help people continue with their payroll so that we wouldn't be laying people off. So it was based off of 2019's income and wage expenses. And then we got that as a loan, and then we had to go through a forgiveness. And so we'll go through that, but I'm not seeing very many responses coming in now. So really most people here didn't apply. We got about a third that did, several that don't own the business that would have been eligible. So we got those results there. Let me click through here. So like I said, this was a program that went through SBA, and there was a lot of confusion because it went through the SBA, whether or not farmers qualified at first. But we got through that, got through all that. So I'm not going to spend a lot of time on that application process just because it is closed. August 8th was the last date that you could apply for one of these loans. As I was going through here and with some looking at things, I went up and pulled some slides from an SBA presentation because I just think it's interesting that as we look at this, there was actually 5.2 million loans made. And this was a slide showing how many lenders were involved in that. And so the size, down there was those large lenders really didn't do, they did a lot of loans, but the largest volume was really done by small banks. A few more statistics: Nebraska had 44,000 of these loans, and for a little over $3 billion. Lots of dollars going out. Also interesting, especially as we talk about what is happening in Washington right now and the discussions that are having. Most of these loans were for small dollar amounts. So we heard about some of the big ones, with the Lakers and a few other companies like that who've qualified, but you could have quite a bit of payroll and be a fairly sizable business and still qualify for this. But if you look at that, almost 70% of the loans are under $50,000. And if we include the ones under 100, we're talking about for sure the large majority. So one of the things that they're discussing in Washington right now is some automatic forgiveness for those, and as much for just simplicity and compliance and lowering SBA's workload. Last statistic I'll share with you again. I just like to have statistics. So, but agriculture pulled about 150,000 loans. So again, this was not just farmers. And again, we thought for a while that farmers weren't going to qualify, or there was a lot of confusion there. But we certainly do, and took about 1.5% of the loans went to agriculture. So, okay. Couple more things. Like I said, that application was based off of 2.5 months wages from 2019, or 2.5 months of self-employed earnings. It was a 1% loan for 2 years if you applied under the first funding, and it's 5 years for the second funding. So depending on what date your loan is, you have those terms. You have a covered period. That was the 8 weeks after your funding arrived, or 24 weeks if you made that election. Again, that was something that changed in June. And it's an important, as we'll go through this, that we understand that those are options for everybody. The 5-year loan terms is only for those who applied after, in that last bunch, after it was like June 20th, something like that. But the 8 or 24 weeks can go for anybody. Qualified expenses, we're going to include wages. That includes retirement and healthcare costs, as well as utilities, rent, and mortgage interest. Originally, it was set up that the forgiveness had to have 70% come from payroll, and they changed that. Sorry, there's my date. I knew I put it in there somewhere. July 4th was when that was actually signed. So they moved that from 70% of payroll to 60. So again, things were changing so quickly all summer long that it's hard to keep up. And then the other thing that a lot of people don't know is that you actually have 10 months from the end of your covered period to apply for forgiveness. So this puts us long into next year for those who have a 24-week covered period. That puts us probably into at least August of next year before you need to apply for forgiveness or before payment would be due on that loan. Okay. So again, this is a loan that was designed to be forgiven. So we're going to, most of these loans are going to be forgiven. That's what I'm going to talk about as the tax issues of that for this fall. So let me just go through a few things here, because Congress said in the CARES Act that this PPP loan, when it was forgiven, was to be tax-free. And so we were pretty excited about that. But IRS came out May 5th and kind of put a damper on our parade a little bit there, and said that they can't override Congress's choice that that's tax-free income. But they did say that any expenses that you used to get forgiveness then would not eligible for a deduction, which essentially means that your loan forgiveness is taxable, because it doesn't matter if we include the forgiveness in income or disallow the expenses. Either way, it's not tax-free. And so we had a plan early on then that we thought, okay, we're going to wait, because Congress has said from both sides, both parties say that we meant this to be tax-free, and they're planning on taking action to basically override IRS and say, no, we meant this to be tax-free. You can still have those deductions. Obviously, nothing has happened in the last 7 months as far as getting that part included. So we're still waiting. We still think that next stimulus package will have that language in it. So our plan had been to wait for forgiveness until 2021, and then go ahead and deduct those costs this year. And then we have to deal with the forgiveness next year, but we have then a good 14 months from the time you applied for forgiveness until we have to file that 2021 tax return. So we thought we had it all figured out. And then IRS came out on the 18th of November and said that if you reasonably expect to have your loan forgiven, even if it's going to happen in the following year, that you can't deduct those costs in 2020. Okay, so that really threw us for a loop, but it's really a hard thing to understand. And I think most tax professionals feel that that's pretty shaky reasoning that they have for doing that, because it wouldn't, as a cash basis taxpayer, it would be normal that you have these expenses today. We don't have forgiveness in this tax year, so that's not income until next year. So it would be similar to going out and prepaying some seed this fall and taking a deduction for that. And then even next February, your planting decisions change, and you end up returning some of that seed and going either with a different company, or you got a completely different crop. That seed is still fully deductible when you write that check in December. We just have an income issue or an expense reduction in 21. That was the theory that we kind of thought we had. So anyway, now our plan is, as most things, is just to pull our hair out. This is where we're going to go. So we've got some ideas that you can pass on to your tax preparer. But we'll go through a few of these. We said we've just been scratching things off and changing our plans. But what we're at least going to do is exclude those expenses from our tax planning. That basically follows IRS's guidelines. The other option that you could do is file that tax return the way we think it should be done, by allowing those expenses if you don't have forgiveness in this year. But in order to avoid preparer penalties, as well as penalties on your part as a taxpayer, you would need to attach a statement to the IRS, to your tax return, saying, hey, IRS, we don't agree with what you said, and so we filed the tax return the way we think it should be done. I just don't really care for telling the IRS that we did it different than what they told us to. It feels to me like it would be a little bit of an audit risk. And I don't like that plan. So, but it is an option and that you can take. So what we're thinking we're going to do is exclude those expenses from our tax planning, because that puts us on the side of, if we're wrong, our tax bill is going to be less than what we thought. So I'd rather usually do it that way than be higher. And then we're trying to put in backup plans wherever we can, so that we have the ability to change that if and when Congress clarifies their position. Okay, so some of the things we can do, what I'm thinking is probably the best option for most producers is to get a deferred payment contract in place that is about the same amount as your PPP loan. What that allows us to do is you're going to sign that deferred payment contract that says you're not getting income until January 2nd. But those deferred payment contracts are written as installment sales. So we have the option under the tax code to just, if we want to recognize the income from a installment sale, we can elect out of that by just recognizing the income. So we could make that decision later on, that if Congress says we get to have those expenses that we planned on disallowing, then we pull that contract in and we end up in the same spot that we were. We can also use depreciation to make those adjustments. So if we end up having more deductions than we thought, we can back off how much 179 we were going to use. The downside to that is that ends up being a choice that we're spreading those costs over 7 years, where the deferred payment contract allows us to make that adjustment in 21, and so a little faster. We could also do things like if we had planned on doing a traditional IRA, we could switch that to doing a Roth IRA and get in our income back up that way. But once we get to the first of the year, it's harder to make those adjustments. But those are some things that we can think about. And another thing you can think about here, and I'll talk about it a little bit more in detail towards the end, but you might think about filing an estimate by January 15th to give us more time to wait on Congress. And that will allow us to wait until April 15th to pay the remainder amount and file. Because one thing that really kind of scares me is if they wait until March to make this clarification, or even late February, that we'll have a lot of tax returns filed, and then we'll have to amend to make them right. So I don't want to do that. Okay, quickly, I'm going to run out of time, and then so many things to talk about. For the self-employed individuals, as you think about forgiveness, one thing I think that you want to make sure is that we want to choose that 24-week forgiveness period. We can go through the math, but essentially, when you're self-employed, we don't have any expenses to disallow, right? So this is actually because we don't get to deduct payment to ourselves as a self-employed person. So there's no deduction to disallow. So for the self-employed, we really truly do have a tax-free forgiveness of this loan because we don't have to include it in the income. We're going to have, we can get maximum forgiveness strictly on income replacement if you choose the 24-week. If you choose the 8 weeks, you're going to be limited to only $16,000. And this is, again, if you had $100,000 of profit, which was the max. And you're going to have to choose to get the rest of the remaining part of your loan forgiven with expenses. And then we're back to being disallowed. So if you're self-employed, just make sure you file your application as a 24-week covered period. Take it all as income replacement or wages, however they classify that, and you will have a strictly tax-free forgiveness there. On the employer side, you can choose either the 8 week or the 24. There's really no difference as long as you have enough expenses in either one to get those forgiven. We're going to exclude that PPP amount from expenses. Again, that's our best strategy at this point as we wait on Washington to get something more clarified to us. We are going to report that as a negative miscellaneous expense on the tax return. We don't want to reduce wages because that could reduce your 199A deduction. And again, that's a whole nother hour-long discussion of that, but we could have some negative effects there. And also, if you reduce your expenses, you're not going to have true costs. And then when we come to management, we're going to have some problems there. The only thing from an employer standpoint, as far as strategy for forgiveness to think about, is if you did have a reduction in employees. So if your full-time equivalent's reduced during your covered period, you might want to look at either the 8-week or the 24 and see if you can get that replaced, because there will be a reduction in what you can get forgiven if you reduced your employees. And there are those individuals who will be self-employed and have employees. So we're going to have to split that loan. It's going to be, I think, my strategy will be to ask for those forgiveness papers to be just part of the tax documents that you bring in, because we're going to need to know how much of that was income replacement and how much of it was reduced expenses. Again, I did just a little math, and you can look at Ryan's got these slides for everyone to have, but there is a big difference in this tax-free status. So I just did, again, a max loan on 100,000. If you're a C corporation and you have to reduce those expenses, it's going to be a tax impact of about $5,800 versus a self-employed person getting the exact same money and not having to pay taxes on it. And if you are self-employed and you have employees, we're talking about an even bigger difference. I mean, almost half of that could be gone in taxes. So it's certainly a very different treatment, and we need to pay attention to how that's going to be handled. And hopefully Congress answers our questions sooner rather than later. Okay. The other thing that we got to pay attention to when we're talking about PPPs and how we're recording this in your books is if you got an EIDL advance. So there was another program inside the CARES Act that they authorized to use the economic injury disaster loans. And those were opened up to farmers, and that included a $1,000 advance per employee. So you could get up to $10,000 in this advance. If you took the EIDL loan before you took your PPP, then they reduce your PPP by your EIDL advance, and you don't have anything to worry about. But a lot of people took the EIDL after their PPP because that was something that, as we were trying to figure out how this affected and farmers, it took a little bit longer. So if you did that on your PPP forgiveness application, then they're going to reduce that. So if you got a $10,000 PPP and a $2,000 EIDL advance, the most you can have forgiven is $8,000. Okay. We do know definitively that the EIDL advance is taxable income. So we don't want to have that EIDL advance in taxable income and then have you reduce your expenses by all of the PPP funds, including what wouldn't be forgiven. So we don't double up. Okay. So the only thing worse than the PPP's expenses being disallowed would be to pay tax on them twice. So just be real careful if you did both of those things. Again, I'm going to leave this that you can review in the slides, just because I think there's other things that we can talk about that are more important. And we can keep going, but this is just some tips on how to actually put this into your accounting reports. But I think the most important thing is that this is separately stated so that your tax preparer can easily identify what is PPP and have them available for them, your forgiveness application, so that they can distinctly be aware the difference between that income replacement for the self-employed and what was done as a reduction that will have to reduce expenses, again, until Congress clarifies. Probably heard a lot about potential PPP2. That it seems a little less likely now than it did a few months ago. Not so much talk about this, but there is $134 billion that was authorized that never got spent. Okay, so in that second authorization of that, so there is talk that they could open that back up. It might be more targeted to specific industries. But one thing to watch for that, because it could be interesting, is in the HEALS Act, which the Senate passed, but the House did not this summer. They actually flipped it a little bit for farmers only to be able to look at gross income instead of net income, because we had a lot of producers who had negative Schedule Fs and did not qualify for the PPP. And so we'll have to watch that. So just pay attention to something that's at least being thrown out there as an interesting topic. So Okay, let's talk just quick about some of these other programs and how they're taxed. Pretty much everything else is going to be just the same as any other government payment that we're used to getting. So the MFP3, the CFAP 1 and 2, the ARC or PLC, all of those are going to be taxable on your Schedule F or whatever business form you're normally filing. That does include the $12,000 assistance from Nebraska, if you got that. So Nebraska got money through the CARES Act that they distributed first to livestock producers and then opened that up to a lot more businesses. But there's nothing in the federal code that excludes that from income. So that one is also taxable income. The only thing that we could potentially have tax-free is that PPP loan. Remember that there's no deferral of any government payments allowed. The only one that you could potentially do would be if you're applying for the WIP programs. But in order for those to be deferred, and the same goes for crop insurance, that deferral is allowed from during the year of production, the year of damage. So crop insurance that we received in January of 20 for the 2019 crop, we can't defer to 21, okay, because it's only the year following production. So a lot of those WIP payments are being claimed on 18, 19 years. It would have to be damage done in 20 for them to be potentially deferred until 21. So again, only crop damage. And you still have to meet those other tests that you're a cash basis taxpayer, that you normally sell the crop in the year following production, those sorts of things. So, okay, last thing, economic stimulus payments or the economic impact payments or the stimulus checks. That's the $1,200 per person, $500 per child under the age of 18 or 17 that you received if your income fell into the guidelines. I didn't put that on the slide, but that's it was between $75,000 and $90,000 if you're single, or double that if you're married filing joint. If your income was higher than that, you didn't get a stimulus check. If it was in that range, it would have been prorated. These are also not taxable income. Okay? This is done through a 2020 tax credit, and they just gave you an advance on that. So don't include this in your income, but your tax preparer is going to need to know how much you received in order to prepare the 2020 tax return. Okay, because if you didn't get all of it and you would qualify in 20, you can get the remainder. If you qualified in 19 but you don't qualify in 20, you don't have to pay it back. The only time you have to pay back is if you received some of the significant amounts of money that went out to deceased taxpayers. Those are the ones that you would have to pay back. But we do need to know about that. Final random payment that just to talk about quick is that Syngenta payment. If you were a part of that, that is Schedule F income. It's just farm income. It's a replacement of income. It's not a government payment, so don't include it with that. It's just going to be another farm income is how we think it's going to be best to report that. So, and they are saying still that there's going to be another remaining amount paid. They only paid 65% up front. And slated the rest for late fall. So you can decide what late fall is, as we have 21 days left in the year to receive that. So, okay. Couple things on net operating losses. And again, I'm not going to go into a lot of detail because this is going to be specific to a few number of people. But if one of the things that, again, probably makes my head spin as much as anybody else's, is they changed the net operating loss rule. So actually, the first change happened with the Tax Cuts and Jobs Act in 2018, and they eliminated the ability to carry net operating losses back for anybody other than farmers. So farmers after 2018 could carry back 2 years, nobody else could carry back at all. The CARES Act basically put a hold on the Tax Cuts and Jobs Act changes. And that sounds simple, but it's not, of course, because the rules with NOLs are that the default is that you have to carry them back, or you make an election to carry it forward. So by the changes in the CARES Act, any losses in 18 or 19 that we already filed before this was done, now automatically have to be carried back. They did give us a provision that we can make the election to carry those forward on the 2020 return for 18, 19, and 20. But if you don't make that election, you have to carry it back. And that might be a good thing for a lot of farmers. So it's, again, if you have those NOLs, it's something to discuss with your tax preparer, because it's important that we make that happen right. But if you think about those 2018 losses, might be very beneficial to carry back into 2013, when not only were incomes higher for farmers, but those tax brackets were higher in 2013 to 2017 before the Tax Cuts and Jobs Act. And so you might get a better benefit for those. So again, just a discussion we need to have. The other business loss issue, and this is the way my head looks right now, so I don't know if anybody else is spinning a little bit, but the Tax Cuts and Jobs Act, again, that was what was passed in 2018, limited business losses to $250,000 or $500,000 if you're a married filing joint. The CARES Act suspended that again through 2020. So again, if you had those in 2018 or 19, we're going to have to amend tax returns to handle those correctly now that the laws are different than how they were when we prepared those returns. And again, that could be a good thing for how your income is done. So we want to make sure that we take a look at that and get that benefit. Okay. A couple things here from an individual standpoint. There was a provision that you could take out $100,000 out of your retirement plan with no penalty, even if you aren't 59 and a half. Okay, you can actually spread the tax over 3 years, and you can repay it over those 3 years and then not pay the tax. Distributions have to be made by December 31st for that. That's when the deadline for that one's done. There are some qualifications. So you have to have been diagnosed with COVID, have a spouse or a dependent diagnosed with COVID, or have an adverse financial consequence. And so those things are going to have to be documented. So I know a lot of people feel they had the symptoms of COVID. If you don't have a test, we can't do a lot of these things. So maybe it's important, if these things are going to be an impact to you and you haven't gotten COVID yet, when it's your turn, go ahead and get the test so that we have the documentation for some of these provisions. And there's a bigger one coming later that might have more of an impact, but something to think about. Again, this is probably not going to be used a whole lot. There's going to be a lot of complication with that, spreading it out over 3 years and getting it repaid and then amending to get the tax back. Could cause some problems, but it is an option if this is something that you need to think about. They also waived the required minimum distribution requirements for 2020. So if you're age 72 or above, you don't have to do those requirement minimum distributions this year if you don't want to, or if you haven't already. And just for those who are scratching their head at the age 72, there was the Secure Act passed last December about this time that changed that age requirement from 70 and a half to 72. Okay, so some people will have actually had to have taken a distribution in 19 and won't have to take another one here until 21 or 22. So, okay. Quick note on charitable donations. Another thing in the CARES Act is they allowed individuals to have a $300 above the line deduction. So what that means is you can deduct $300 of charitable giving without itemizing. Okay, so a lot of people have stopped itemizing when they raised the standard deduction so much in the Tax Cuts and Jobs Act. But this one we can still do even if you take the standard deduction. So make sure that you turn in your receipts that show that you have that $300. Again, it's not huge, but we take everything we can get. And if you're thinking about being very charitable, they also changed for 2020 only that you can deduct up to 100% of your AGI for charitable donations. That has to be done on Schedule A, so itemized deductions. But you can give up to 100% of your AGI this year. That is a cash deduction, so you can't use that if you're going to give appreciated stock or some of those kinds of things. So there's some rules to it. If you're interested, as always, talk to your tax preparer. And then they did up the corporation's limit from 10% of taxable to 25. So allowing you to be more charitable this year and get a tax benefit for that. Okay, I had another poll in here, but I'm going to skip it just because I want to be able to answer questions. And we're going to talk a little bit here about these employer credits. Again, these are very complex and specific things that apply, but there are basically 3 different employer credits that they authorize to basically help produce or help employers pay for people to be home with COVID. Okay, so the combination of these 3 work together. Essentially, basically what it would do is give reimbursement for wages paid for employees who had to stay home. So the sick and family leave, again, we've got to have documentation that they did have COVID. We can't just say lost the taste and smell, so we knew they had COVID. We have to have documentation of a test result in order to get these things. And I think they're going to be pretty specific on making sure that we have these things. Some of them, like the emergency family and medical leave credit, would cover parents who had to stay home and help their kids because the kids' schools were shut down. Be careful in this though, because some of this is a reimbursement of like 80%, some of it's 100%. They're all different. And so again, if this applies, it's really important that we document that well and talk to your tax preparer and making sure these get filled out right. So these credits are claimed either on your 941 or your 943. Those are the forms that you file to show that you had your payroll taxes paid in. I believe the 941 is now up to a 4-page form because of some of this stuff. Again, it got complicated, but it's important that if you had to pay for employees to stay home for whether they were sick, somebody they were caring for was sick with COVID, or their kids were out of school or daycare was closed, that we can get reimbursement on those things. One thing to watch for is right now, you cannot use these credits if you use those same wages for PPP forgiveness. And so a lot of that doubling up, like when the schools were closed, would have been in the same time frame that we were using wages for PPP forgiveness. So be aware of that. But if it's something that they're home now, this could certainly apply. Okay, and there is ways to get these. Again, now we're close to the end of the year. Probably not a big of a deal, but there are ways that we could get advances on those without waiting for the 943 to get filed. Okay, again, very complex and probably applies to a very small number of people. So we'll keep going. Again, I mentioned that January 15th estimate. Remember, we always think about farmers' taxes are due March 1st, but the reason for that is just to get out of paying quarterly estimated taxes. Their tax returns still technically due April 15th like everybody else, but we file and pay by March 1st to avoid penalty by not having estimated taxes paid in. The other option that we have is to pay either 100% of last year's tax or 2/3 of what we expect this year to be by January 15th. Then we have until April 15th to pay the remainder and file the return. Always good in a year, if you've got investments and things that don't come until late February. But this year, probably more than anything, it allows us more time again to find out what's going to happen for sure on those PPP answers, as well as what they're going to, what potential changes there are for future taxation, whether we think rates are going to go higher, what kind of changes are they going to make next year. That gives us a little bit more time. And from a preparation firm standpoint, it allows for some of those COVID bumps. There's one, we discussed that, one of our biggest risks right now is having a outbreak of COVID go through our office and have people who are unable to work. And during these times when we have such tight deadlines. So it gives a little bit more flexibility that way as well. One other thing on those credits, that the employee has to be unable to work. So for those of us who are able to work from home, but we had to be home, that is not eligible for those credits. So again, a random thing, not part of the CARES Act or anything there, but we do have a new form 1099 NEC. So that's non-employee comp. This stems from a rule change a couple of years ago about the timing of when the 1099s have to be filed. Not necessarily issued to the employer from a producer standpoint, but when we have to have them e-filed with the government. So they separated off this non-employee comp. So this is any of the custom work that you have done, things like that. And so this is going to be on one form, and then we're just going to have another form for rents, crop insurance, government, or other things. So there's a lot of things that go on this form, but I wanted to point it out just in the fact that you might be getting more 1099s than you did in the past. And they might just look a little different, but going to be a little change this year. I always get lots of questions about depreciation. That is, so I just wanted to give you another reminder that in the Tax Cuts and Jobs Act, we got permanent $1 million 179 index for inflation. So that's going to continue to roll up. It's more than $1 million right now, but that's going to continue to roll up. And we've got bonus depreciation through 2022. So we're starting to get to where we're looking at that deadline as potentially going away. It will phase out between 23 and 27. So from a farm standpoint, we're really talking about machine sheds would be the things that we can use bonus for that we can't use 179. So if that's on your wish list, the next couple of years would be a good time to get that done. All right. And one more poll question I'm going to skip through here, but one other thing you might think about, again, is just if your crystal ball is clearer than mine, I would love to know what you think, what's going to happen for tax rates. But with the sheer amount of money that the government has issued out in this last year, as between the CARES Act and some of the others, thoughts of tax increases are probably likely. So one thing you might think about in 20 is recognizing more income while we have these really low rates, even though it's a larger amount, but it would be better than maybe what we have paying forward. And then the last tip I have for you is to maybe think about paying your taxes electronically, and not necessarily, I mean, everybody's e-filing, those kinds of things, but actually having the taxes either taken out of your account with the tax return or paying them with these systems. Both Nebraska and IRS have them set up. And one of the things that's going on with IRS right now is they shut down like everybody else did. And of course, during the filing season, so they had literally truckloads of mail sitting outside all their service centers. And we've received lots of notices of where they received the tax return, but not the check, and things just got messed up. So their best recommendation is not to send checks and to avoid the mail as much as possible. So if you're going to pay those taxes, this is certainly something to consider so that we have a exact date of when those were sent, and we can set them up so that they come out on the due date of your returns. You don't have to pay early, but just something to think about. So, all right, not a lot of time left here, but Austin, do we have questions that I can answer?
Yeah, so going back to the beginning of the conversation when we first got started, we had a question come in under the Small Business Association Debt Relief Program. Up to 6 months, SAB loan payments were forgiven. Are those forgiven payments taxable income?
I don't know that off the top of my head. My first response would be yes. Any debt forgiveness is taxable. And just because I spend all my life working with farmers, and normally we don't get SBA, so most farmers don't have SBA loans because they have FSA loans. I don't know that answer off the top of my head. I would have to look that up. My gut would say yes.
We had another question come in dealing with the charitable contributions you brought up a little bit ago. Is the $300 deduction per taxpayer or per tax return?
Per tax return, actually. So yeah, single gets 300, married, filing, joint gets 300.
If anybody has more questions, definitely feel free to type them in the chat or in the Q&A, and we're open to answering more. We've got one. This is the first year I've owned/inherited farmland. Any key items I should collect for my CPA?
I think just general business, we need income and expenses. They're going to need to know if there was any assets on that farm ground, so that they can get that on depreciation. They would need to know what values were placed on those assets through the estate. So if there was a pivot or a well, they would need those values. So if you have a copy of the estate tax return, that would be important. If there was no estate tax return filed, should have been a county inheritance return filed, and you can use those values.
Okay. Will the W-2s have reconciliation requirements for the PPP forgiven amount?
I don't think there's anything in the 943s or the 941s that have anything to do with PPP. You're going to have to prove wages on the PPP forgiveness application if your loan is more than 50,000. Right now, the application for loans less than 50,000, they call it the simple form. It pretty much certifies you say that you did what you were supposed to, and then you just have to have the documentation available for random checks. But I don't think there's going to be anything on the 943s or the W-2s that have anything to do with PPP.
Okay. Are the Small Business Association EIDL loans up to 150,000 considered taxable income?
So we talked about the EIDL advances that you could get, but in addition to those advances, you could actually also qualify for an EIDL loan. Those loans are actually loans, and so they're not taxable income. You're going to have to repay those. They have a low interest rate and a long term to pay those back, so they're kind of a nice cash flow increase. But those are loans and should be treated the same way. So no taxable there, just the advance part.
We've got, it might be unrelated, but we've got, for beginning farmers, is there a minimum they have to have on a Schedule F to qualify? Long-term, I have been told that they have to have 3 years of Schedule F in order to apply for the beginning farm loan / programs.
I'm not, not positive on I assume these are FSA loans that we're talking about. I think it's just Schedule F. It doesn't have to be a certain amount of income. They just have to show. So even if you're filing Schedule Fs for an FFA project or a 4-H project, something like that, those would qualify. So I don't think that there's any minimum requirement for that.
These are great questions coming in. If you got more, keep firing them off and we'll go through them.
I think, Austin, one of the most important things we can get out of this is the importance of doing tax planning at this time. A lot of people feel like if incomes are down, we don't need to do tax planning. But every year, regardless, there's got to be so many things that are coming up. But this year, there's just so many unknowns and so much of the government payments, and it's certainly going to be important that we get a handle on where you're at and making sure that we take advantage of everything we've got. So
I've got a question. My accountant told me the $1,200 stimulus check might need to be paid back by income levels this year. Is this correct?
Actually, no. So I guess this one was set up as a best of all worlds rule. We don't get those very often with IRS or with taxes, but if you received one based off of 18 or 19 because you qualified then and your income is high in 20, you do not have to pay it back. But if you didn't qualify in 19 and your income's lower in 20, you'll get the credit. So we couldn't get the best way. Like I said, the only one that you have to pay back is if you received one for a deceased taxpayer, and there's some rules on that. IRS's website has a really great informative page on their economic stimulus payments. And they'll give you the instructions both on who would have to pay that back and how to go about, how to go about doing that. But that would be the only situation where you'd be asked to pay it back.
Well, if you got more questions, definitely get them typed in the chat and we'll get them answered. For everybody else, thank you everyone for joining us today. The recording of this webinar will be posted at farm.unl.edu, where you can also register for upcoming webinars. As a reminder, check farm.unl.edu for a schedule of more webinars in this series, focusing on farm and ranch management issues relevant to Nebraskans. The series wraps up next week on Thursday at noon with an update on farm programs and ag policy heading into 2021. After the program, you will receive a short 30-second survey in your email. And we want to we really appreciate your feedback on today's webinar and your input into future sessions. Thanks again for joining us. We do have another question that just popped in. We've got a recommendation that we do another one on tax planning. You game for that?
We could probably talk for a couple more hours on these topics, so I could always talk about it.
Well, I do want to give one final thank you to everybody. We'll go ahead and end the broadcast, but thank you for joining us for today's webinar and the Farm and Ranch Management Series. And we look forward to seeing you again. Definitely check out the farm.unl.edu website to make sure you stay up to date on what the upcoming webinars are and to find recordings and slides of previous webinars that we had broadcasted. So thank you.